The bond that eats lunch, capital appreciation bonds. To understand why the gym floor stopped and the orchestra vanished, meet the bond that eats lunch. A capital appreciation bond looks harmless on a slide. Borrow now, pay nothing for years, then start repaying when, supposedly, the community is richer. No coupons. No checks cut today. Interest quietly stacks on interest, compounding like a credit card you never open. By the time payments begin, the original principal has swollen into a mountain. Here's how it plays out in a boardroom. The CFO shows two columns. Option A, a standard bond that raises taxes a little now and costs roughly 2 times principal over 25 years. Option B, a CAB that keeps the tax rate flat today, promises images of new classrooms, and pushes payments into the 2030s or 2040s. On paper, the CAB solves a political problem. The phrase "no tax rate increase" survives the ballot. The cost column that matters, total repayment, slides to a footnote. The math is punishing. Districts have signed CABs where every $1 borrowed becomes $5, $8, even $10 repaid. California saw notorious cases. One where roughly $30 million raised required nearly $280 million decades later. San Diego County issues reported by investigative outlets. And another where about $105 million grew toward $1 billion, Poway Unified widely cited. In 2013, California capped repayment ratios, generally 4-to-1, and timelines, but the logic stays attractive where budgets are tight and debt caps block plain borrowing. You get something today, you promise a lot tomorrow. Why do boards say yes? Because the upfront pressure is real. State aid is unstable. Voters are wary. Debt limits based on assessed value can block standard structures. CABs thread a political needle. No current year payment means no immediate tax bump, and no need to cut this year's staff to start paying for a roof. Underwriters sweeten the pitch with fee-light slides, emphasizing future flexibility that rarely materializes. Advisors tell you everyone's doing it, and remind you rates are low, so the future burden won't feel so heavy. But the fees are there, just embedded. Underwriting spreads, advisor compensation often tied to deal size, insurance premiums, legal fees. None paid by cutting a check today. They're baked into yields and structures, then folded into the compounding. The farther out you push the first payment, the more the stack grows. One detail proves crucial later, the call feature. Many CABs can't be called, or can only be called with a premium after long lockouts. That means when rates fall, or when you realize the deal is strangling you, you can't refinance without paying. Meanwhile, rating agencies sit in the background, watching the same spreadsheet. They prefer predictable coverage and plans that fit their models. When enrollment dips or assessed value stalls, that future balloon looms larger. Administrators plan around it years in advance. You'll hear structural balance, coverage ratio, and headroom where counselors and art used to be the topic. Then the human part hits. When payments start, they bite. Debt service can jump by millions in a single year. Districts freeze hiring, pause PD, and collapse electives to meet the schedule. Some cuts become permanent because the debt service line can't flex. You can lay off a librarian, you can't renegotiate a bond indenture. One district finance officer described the day the amortization flipped from low to high as the cliff. For years, they'd paid nothing on the CAB tranche. Then the calendar turned, and the payment dwarfed any prior debt service. The board meeting that month ran late. Parents demanded to know why a new STEM wing was open while elementary class sizes ballooned. The answer didn't fit on a flyer. 10 years ago, a board chose a bond that postponed reality. Who's on the other end? Investors who want long, tax-exempt cash flows. Mutual funds, insurers, and separate accounts see CABs as deep-duration assets. They collect later, but they price the risk today. Underwriters earn now. Advisors move on to the next district. The only party forced to live with the compounding is the school system and the families it serves. And it's not just one issuance. CABs often come in series, layered across projects. A district with 3 CAB tranches can face a staircase of ballooning payments over a decade. Try budgeting under that. Try bargaining with teachers when next year's raise competes with a bond you can't call. The spreadsheet wins. Some states learn. Caps on repayment ratios, limits on terms, early redemption requirements, guardrails that should have been common sense. Where those rules don't exist, the temptation remains. Shiny renderings plus no-tax messaging still beats a candid talk about paying now to protect classrooms later. In that gap, CABs keep getting sold. The kids don't see any of this. They just see a hallway become a lunchroom and an orchestra vanish. The bond that kept taxes flat when they were in kindergarten sends a bill when they're in middle school. And the debt service check clears before the first bell. Inside the $1.5 trillion market, who's holding your kid's school? Follow the coupon. Once a bond is sold, those future payments, your district's promise, move into a market bigger than most people think. The municipal market sits a little above $4 trillion. 12 districts are a sizable slice alongside cities, counties, utilities, and hospitals. Inside that pile sit more than 1 million unique CUSIPs over time. Your school's debt is one thread in a fabric traders pull on every day. Who holds it? Start with mutual funds. They're the quiet giants, tax-exempt funds built for retirees and high earners who want steady income. They buy the longer maturities, clip the interest, and hold through bumps. Insurers sit next to them, matching long liabilities with long assets. Separate accounts, think wealthy families or institutions, build custom ladders of bonds, including school districts they trust. Then there are hedge funds and crossover buyers who jump in when spreads widen, betting on mispricing or distress. They don't need your school to thrive, they need a trade to work. Here's what most voters never see. After new issue day, bonds trade. Not every school bond flips, but when it does, markups can be real. A teacher in a retail account often pays more than an institutional desk that buys blocks. The spread, what the dealer pockets, sits in the difference between what they paid and what you paid. It won't be on a ballot. It might appear on a trade confirmation days later. Meanwhile, ratings hang over everything. Moody's and S&P don't run your school, but their letters shape it. A notch down can add basis points to borrowing costs, which translates to bigger checks out of future budgets. District CFOs study those criteria like finals, fund balance policy, revenue diversity, enrollment trends. If a downgrade threatens, boards delay hires, boost reserves, sell assets. Moves meant to reassure analysts, not students. According to regulators and market surveys, this market is sprawling and fractured. With more than 1 million distinct bond CUSIPs outstanding over time, data is thin and liquidity can vanish at the wrong moment. Liquidity is friendly in calm times. In a scare, say a pandemic, money hides. Funds face redemptions, dealers widen quotes, and yields jump. That's when a routine refinancing suddenly costs more, or can't happen at all. The irony is hard to miss. The safe, tax-free income that drew investors turns into leverage over a district that can't miss payments. You feel it locally as we can't refinance until the call date, or the savings aren't there. The market is having a mood, and your curriculum adjusts. A microstory. A suburban district planned to refund older debt and save a few million over 10 years. The window looked perfect. Then headlines hit, ratios spiked, and the bid disappeared. The savings evaporated in a week. The board meeting turned tense. The superintendent said, "We'll try again next quarter." The maintenance budget took the hit that year. Kids saw buckets in the hallway after storms. On the buy side, funds are professional. They compare your district to dozens of peers. If your tax base is shrinking or charters siphon enrollment, they'll demand more yield. That's not malice, it's math. But the premium they ask comes from somewhere. Fewer paraprofessionals, deferred textbooks, a later start on HVAC. Every extra basis point becomes an unpurchased book. The trading desk doesn't see that. They see a green blotter and settled funds. There's also structural power in who sets the story. Official statements, the long documents districts file, are written as much for investors as for voters. They detail covenants, coverage, risks. Buried lines warn that state aid can change, property values can drop, enrollment can fall. When any of that happens, the market reacts first, then the classroom does. If a rating watch appears, district leadership schedules calls with analysts before they schedule a town hall. And then, the secondary market's quiet advantage. Institutions can exit. If a fund no longer likes your district's trajectory, they sell the bond and move on. You can't sell the obligation. You are the obligation. The debt service line is a fixed appointment on the calendar, enforced by law, monitored by trustees and paying agents. The only elasticity in the system sits in classrooms. So when you hear the market liked the deal, know what that means. Underwriters placed the bonds, fees were earned, funds found their yield. The deal's success gets measured in minutes. Your school will measure it over decades. The holders will change. The CUSIP will pass through accounts you'll never know. The music program will either exist or it won't, depending on how those basis points shook out when someone hundreds of miles away clicked buy. Sale-leasebacks and the classroom landlord. The bond market is only half the story. The other half lives in bricks and deeds, the moment a district becomes a tenant. It starts with a cash crunch and a promise. Unlock equity in buildings without raising taxes. The pitch sounds simple. Sell a facility today, lease it back tomorrow, keep teaching in the same walls. Cash up front, no new debt on paper. But the minute the deed leaves, the school gains a landlord. Here's how it unfolds in a cabinet meeting. The facility's director lists roofs at end of life, HVAC failures, safety upgrades. The CFO shows dwindling reserves and a ballot that just failed. An advisor slides over another option, a sale-leaseback on non-classroom property. Maybe the admin building, a bus depot, a warehouse. You'll monetize an underused asset, they say. Then redirect proceeds into classrooms. The catch comes in the lease. 20 to 30 years, triple net, with annual escalators and limited renewal options. Maintenance, insurance, taxes, if any, shift to the tenant. That tenant is the district. Triple net sounds efficient until the first big repair hits. Under a standard lease, the landlord shares responsibility. Under triple net, the district pays for the roof on a building it no longer owns, plus rent that ticks up every year, often tied to CPI or set at fixed steps. Flexibility becomes a ratchet. Some deals even restrict reconfiguration or consolidation. If enrollment falls and the district wants to shrink, the lease still demands occupancy and payment through year 25. Meanwhile, charter operators and their backers learn to scale this model. Facilities funds buy or build schools and lease them to charter networks at cap rates that look attractive to investors. The returns start to resemble REIT plays. Long-term, predictable cash flows secured by public-to-pupil funding, often securitized through conduit issuers. When you hear facilities partner, think landlord with a calculator. If a charter misses enrollment targets, the pressure to cut staff or programs to meet rent intensifies. In some cases, lenders set enrollment covenants. Expansion, relocation, even closure dates can be negotiated in conference rooms far from the classroom. Now bring it back to a traditional district. A sale-leaseback delivers millions up front. Those dollars land like a lifeline, new boilers, ADA compliance, security upgrades. But they don't erase the new fixed cost. Every July 1st, rent is due. If state aid slips or local revenue dips, the landlord still expects the check. When budgets tighten, the district can renegotiate salaries. It can't renegotiate inflation that's baked into a lease escalator. A microstory. A Midwestern district sold its central office to an investor and signed a 25-year lease with 3% annual increases. Year 1, the proceeds funded classroom tech and a roof replacement, wins that photographed well. Year 8, utility costs spiked, enrollment softened, and the rent had climbed nearly 27% from the starting point. The district considered consolidating admin into an empty wing at a high school to save money. The lease blocked subletting and charged a steep fee for early termination. The board swallowed the cost. Art supplies were trimmed again. Another twist, control. Ownership lets a district rethink a campus. At a pre-K wing, carve space for mental health services, swap a library layout. Under a lease, any change can trigger landlord approvals, extra inspections, or rent adjustments. In some sale-leasebacks, the investor reserves the right of first refusal on nearby parcels, steering future planning. Over time, real estate strategy shifts from educational vision to negotiating leverage. The facilities map answers to yield. Supporters argue sale-leasebacks transfer risk and unlock capital without voter fatigue. Sometimes, they've helped build or modernize space that bonds and budgets couldn't touch. The problem is the discipline it demands. If proceeds patch recurring deficits instead of one-time needs, the district trades a balance sheet problem for a structural one, permanent rent replacing temporary relief. And with triple net, the risk doesn't really leave, it just returns under a different line item. Charter facilities deals show the other edge. Investors package properties, securitize rents, and market predictable streams. The financial engineering can be elegant. But when a school underperforms, the investor's remedy is real estate. Raise rent, enforce covenants, or move to evict. The community's remedy is messier. Find seats elsewhere, extend bus routes, close libraries to make room. The spreadsheet credits rent received. The map gains a school desert. During crises, these structures harden. In a downer, refinancing a lease isn't like refunding a bond. Landlords guard cash flows. They aren't obligated to help you through a bad year. If an escalator ties to CPI, and inflation spike locks in higher rent at exactly the wrong time, the only flexible items left are people and programs. That's how you end up with a sparkling vestibule funded by yesterday's deal and a bare supply closet because this year's rent went up. There are better versions, shorter terms, modest escalators, repurchase options, true maintenance sharing limited covenants. They require leverage and transparency that districts don't always have. And they demand a clear rule: never sell mission-critical classrooms. Own the spaces where students learn. If something must be monetized, start with peripheral assets, embed buyback rights, and disclose the lifetime rent in plain numbers before the vote. Otherwise, the classroom gets a landlord, and the landlord gets first say. The swap that backfired: derivatives in school finance. The pitch landed when rates only seemed to fall. Hedge your risk, advisors said. Swap variable rate exposure for fixed.